All right. Looks like we're live streaming to the Facebook group. What's up, Justin?
What's going on? Can you hear me?
I can hear you loud and clear. Actually, figured out how to do the live streaming, so we are live in the multifamily investing network group as well.
Awesome.
Yeah. All right, we'll give it a couple minutes to get started here. Feel like now is a good time to be talking about this subject. I think Larry pointed that out.
Yeah, Larry's next month, right?
Yep. Yeah. Next month we'll be having Larry with Walker and Dunlop kind of talk about what's going on right now in the market as far as interest rates, where we expect them to go, and should be a good timing then. That's May 16th on that. All right, that's Nick on the other line. He's going to be jumping on here in just a minute. He's actually in the car right now with his family. But yeah, so next month we're going to be having Larry Wildman. He's with Walker and Dunlop. We'll be talking about interest rates and the current multifamily real estate environment. So Walker and Dunlop, very active in the space as far as debt side, equity side. So I'm really interested to hear what he has to say. And I think that'll be good timing too. There in May, after I think where the Feds, I think their next meeting is coming up here soon, or is that in May? That'll be but yeah, I'm really interested. He's got a lot of experience in the industry. So definitely one to save on your calendar. So that's May 16th. We'll be doing that at the same time, 4 p.m. to 5 p.m. there as well. So we try to do this on the third Tuesday of every month, from 4 p.m. to 6 p.m. and have a new different speaker bringing different market insight. Last month we had our CPA, Matt with True Book, speaking on making sure you're filing correctly and different tax savings there. So looks like Nick will be jumping on here quickly. I'll give you guys a brief bio about Nick. So Nick was selected as a Georgia super lawyer as a rising star for years 2021 and 2022. Exceptional award is provided at the top 2.5% of vote earners for the business and corporate. He is very focused on multifamily real estate. There he is joining us. He has transacted on hundreds of millions of dollars of commercial real estate in 2021. So he is our go-to when it comes to our syndication questions. He even drafted up an employment agreement with us more recently, but his main focus is on multifamily real estate. So looks like he is there joining us. His tag says
Send
Justin.
him my link, so that's why it says my name on his picture.
I'll be Justin. Hey guys, can you hear me all right?
We can, yep.
That sounds good.
Awesome. Yeah, I guess we need to get that intro updated. That's probably pulled from my website, and I've definitely done
That
some
is right.
transactions since 2021. So
All right. Yeah. So just telling them a little bit about you. I don't know what the Georgia super lawyer means, but that's on there as well.
yep. No, that's they do those state by state. It's a peer voted process. And so people are nominated and then voted on. And I've been fortunate enough to get that 3 years in a row, 3 years in running. So it's pretty esteemed honor. Not too many awards and honors in the industry. So it's a good one.
Awesome. But yeah, so the subject of this afternoon's event is protecting yourself as a limited partner. You know, we had it as, we know that a limited partner, it's a great way to invest. You know, you are a silent partner and passive, but I think it's important for investors to know kind of the rights, or what rights they don't have, what they should look out for, and structures, maybe some common things that you might see that could be helpful for them when looking at a PPM, or, you know, making sure that they are protected, and making sure that they're the ones getting the majority of the benefits.
Yeah, that's right. And that's a great preface. You know, essentially when you're the limited partner, you want to look at the management and ownership, of course, of the project and the asset and the investment, and look at exactly their, you know, who's contributing this thing, what is their experience, evaluate whether, you know, whether this project that they're working on is one that they've done before, something similar, maybe in this MSA, they have local knowledge, you know, or at least, sorry, I'm in the car right now, Brian and Justin and everybody, and I've got a 2-year-old who's fussing.
We can hear you fine.
You know, ultimately look and see how sophisticated this management team is, right? For example, Elevate, of course, we have proven gone full cycle on a number of assets, shown sophistication in not only the acquisition, but the value add implementation, leasing up, pushing rents, and all of those things that really help boost the bottom line of the investment itself. And just making sure that you know, that we're dealing with true experts in the industry. And so beyond that, looking at the authority documents is really the most critical part, right? We want to, as part of the offering documents, we have to deliver the private placement memorandum, right, the PPM, as well as the operating agreement of the company. And that's going to delineate how the membership is laid out and the rights and responsibilities. And Brian, you hit the nail on the head. Generally, these opportunities for limited partners are silent, right? They're limited in the context of management of the asset and the investment, and limited in terms of liability. So it's important for everybody to note that as a limited partner, there's never recourse against your investment. That doesn't mean that your investment is protected from a loss, but it just means that a bank or creditor or third party is going to look through that entity to take your personal assets. So there is that protection set up, and at least all of the entities, of course, that we design for you at Robinson Fransman. And so I've got my operating agreement pretty much committed to memory. So when looking at our documents, looking at section 4 initially, which is the membership of the company, looking at what class of units are you getting. And then the OA will expound on sort of the rights and responsibilities within that section so that you have a really good understanding of where you fit, in terms of the organization of the company.
Yeah, I think that's you hit the first point too. As a limited partner, you are limited in your say, but that's also for your protection because you're limited to the amount of capital you put in. So no one can go after your net worth or more than the amount that you're investing. So super important part. There's no risk-free investment, but I think as a limited partner, you are protecting yourself on that side.
Totally. And what I was gonna, another thing to interject is subsequent capital contributions are really the only time that really anybody can be diluted. The management is generally not allowed to adversely impact your ownership, just arbitrarily. So just check and see how the subsequent capital contributions are handled, because that's such obviously in today's market and climate, people, want to, I think, project a negative perspective on that, but really a subsequent capital contribution can actually be a good thing in terms of potentially raising capital for for CapEx projects and other capital needs versus taking expensive debt and other things on that could harm the cash flow of the company. But those two sections are really tied together in our operating agreements, and something to pay attention to as well.
That's a good point. Yeah, about extra capital infusions, extra capital recapitalization, capital calls. A lot of different rescue capital. There's a lot of different terms for it now. Here we're speaking April of 2023. Obviously you have your client confidentiality, but is it safe to say that you've seen more of these extra capital infusions in 2023 than years past?
Yeah, definitely. And look, a lot of people, we're in bridge loans for a couple of years now, and a rate cap was a very, it's a risk mitigator, somewhat a risk eliminator from the volatility in the interest rates, right? And so when that wasn't a concern in 2021 and really so 2020, 2021, and really just in the early part of 22, later February is when they started ticking up. People just didn't realize the implication of it. And that's when the rate caps, started becoming prohibitively expensive. And so people were exposed to these increases in the interest rate through their variable rate loans, right? And so, yes, I have seen capital calls go to help subsidize, the payment of those interest rates, just because obviously the NOI is impacted when the interest rate is higher, because now we owe more money to the debt service. And so, yeah, right now we've seen it much more, particularly in my practice. Of late, I've seen a number of those trigger from old loans that have come through. We always, advise to get a rate cap, or the team that we're working with has disclosed those risks, or they're just aware of them and have worked them into their underwriting. But I would suspect that now we're not doing too in a bridge product. We're pretty much seeing a lot of conventional and agency right now, not a ton of bridge anyway. So the loan products coming out now are really just not even volatile market.
Yeah, that makes sense. And I think that's important, like you talked about, like for those recapitalizations, how to look at that, and the dilution if you're not contributing, but if you are contributing, so you mitigate your risk in the back end. And it sounds like it's more on the bridge products is what you're seeing, and which now everything new, most people aren't setting up bridge debt for new acquisitions, as we're talking 2023.
That's right. Some of the bridge lenders, but they're either requiring a rate cap, or again, people, now that we're looking at what we perceive to be really the maximum, hopefully can only trade away from here.
Cutting out a little bit here.
you know, there are operators that have needed capital calls. Yeah, sorry, I'm kind of in a dead zone. Some people are
Oh, muted yourself.
sorry. Yeah, as long as sometimes the capital calls have happened because of poor operation of the property. And so that's where you want to look, and that's why it's so important to look at the experience of your operators, right? Because if they know what they're doing and they're experienced and they have demonstrated ability, the likelihood of needing a capital call for just the normal operation of the property is mitigated or outright eliminated. And that's the biggest concern. Since we're doing loan products that aren't variable rate loans, the risk there is nil. But I think it's important for the LPs to understand that these are the questions you need to ask of your operators. What kind of loan product is it? Is it a fixed rate? If so, what's the rate? Is it variable rate? If so, are we doing a rate cap and things of that nature so that they can get out ahead of the debt risk?
What kind of red flags would you advise LPs to look at when maybe things, operating agreements or anything that you've seen that they should look out for a limited partnership?
Really, you know, really looking at the compensation of the manager and just making sure that it's reconciled with, you know,
Cutting out again. So we got cut off at the compensation of the manager.
yeah,
Where are you?
compensation of the manager is where I look for acquisition fees, certain fees that are paid on the front end, and just understanding like, hey, the landscape of the deal. The operator deserves an acquisition fee, but again, are they getting it as an initial like payout, or are they getting because truly they have demonstrated experience and this is sort of their success fee in getting into this deal? Because all the major main quality operators take an acquisition fee. It's the exorbitant acquisition fees in a newer operator where you don't know what they're going to do with an asset and they're getting paid an exorbitant amount of money on the front end of a deal. So again, all of this, as you can tell, harkens back to the quality of the leadership.
Yeah, for sure. I think that, yeah, that definitely circles back to what you're talking about, making sure you're signing up with good sponsors, good operators that have experience, especially in the product that they're delivering and the asset type market. You know, those are all, you know, green flags for me as far as when I'm looking at passively investing in deals too.
That's right.
Anything?
That's right.
Anything on any structure, like as far I understood on the upfront fees, making sure those are in line with market. I think what we're generally charging is around 2% right now. On the acquisition fee, Elevate is. What about
That's
structure?
market. That's definitely market. I mean, structure is important. You, to the best of your ability, you want to be looped into the property owning entity. But as you've experienced, and particularly in bridge loans, a lot of times they want to put a bankruptcy remote SPE as the property owner. And then it has a single member that's like a pledgor, and then the third entity down is the one that is the investment company. You're still owning that when there's single member LLCs above you. So just making sure that you truly are connected, you know, to the investment itself, so that you really have that tangible ownership of the fund. That's been one of the biggest knocks in an actual real estate fund, is you feel so attenuated from the actual ownership of the real estate. In a syndication, you should be, you know, it should be a piece of that dirt that you own directly. And so look at that, and if it looks like you're not a direct owner of it, ask questions of your GP and just try to get an understanding of the structure. And of course, as you know, my firm provides guidance on what structure should look like, and whether and to what extent you are connected to the asset, or if it looks attenuated enough from it that there's a concern there.
That's great, for sure. You know, I think gone are the days of the 50-50, you know, back of the napkin partnerships. You know, I think the real estate community's got a lot more sophisticated than you know, one person puts up all the money, they get 50%, the other person, you know, does all the work and they get 50%. You know, I think that's very kind of the old school handshake agreement structure. But for us at Elevate, we 100%, we see our investments through the eyes of our investors, and Not saying you need to invest with us, but when you're looking at it, you want to make sure that you are, treated with some sort of preferred return, making sure you're getting the majority out of the upside. We add an investment, like some sort of performance hurdle in our structure. So whether that's, usually somewhere in the teens IRR. So incentivizing us to actually not just get the property and sit on the property. We want to get to that higher level IRR so we can then get to that and increase hurdle. Usually, I think our last deal was a 6% preferred return. It was 6% preferred return, 70-30 split, 70 going to the investor, 30 to the general partnership team. And then once we hit that 18% performance hurdle, then it went to a 50-50 split. So it's not coming out the gate as 50-50, but we have to hit a certain performance hurdle to our investors. And that preferred return, we like adding that in there because it, more or less gives you an extra layer of insurance that, you're getting paid that 6 to 8% pref before us as a managers get paid, so 100% of the profits are going to you to that pref, then that 70-30 split until that performance hurdle. So that's where we like to see it. I know some sponsors will add tons of different waterfall hurdles, which, can be fine too. But for us, we like to try to keep it simple on that.
No, that's great stuff, Brian. You guys have I think it's the perfect comp model for syndication. You're rewarding your investors. And again, and I love the terminology of insuring them. Look, the preferred return is really and truly that the first fruits of the company are paid out on that prep. So when a net profit comes in, we're reserving 6% of that cash, and you can think of it as the 6% of the raise. So that's not a small sum of money that's reserved for the limited partners to ensure that they receive compensation and cash flow before the manager is. And let me be clear, no operators have gotten rich on their asset management fee. They could in their acquisition fees. And again, that's why you want to look into the background of your management and their expertise. But the way that this waterfall is the LPs are insured up front, and only by virtue of strong performance in the form of an 18% IRR does that shift more in the favor of the GP, which is a complete, not only market, but an advantageous way to be an operator. And I see LPs across the board co-signing that because they know that the GPs are incentivized to perform.
That's great. Well, I think we hit on a lot of the stuff. I kind of wanted to open it up to any attendees that may have had some questions. Signing any sort of documents, what they're seeing in the market. I don't know if you had some questions queued up as well, Justin, but definitely if you guys out there have any questions, feel free to start.
While we wait on questions to come in, one thing I want to touch on really quick, kind of just going back to like vetting the sponsorship team. Like one thing that doesn't seem that mainstream, but is like incredibly easy to do, is running background checks on the sponsorship team, doing like civil searches, seeing if there's like any like pending litigations or, court cases, what have you. I mean, in my opinion, it seems like really easy, simple, and effective to do. Nick, I don't know if you like in your world see LPs doing that, or if you recommend that people should do that.
Well, absolutely. I mean, look, we run searches, as you know, for the lender, just to confirm that there's no judgment, bankruptcy, UCC, lien search, stuff like that. I mean, look, if you're really a proactive LP, particularly if you've got a risk exposure of 250,000 or more, it's worth the expense in the upfront to do the background searches that you can do, right? Is it market for your, 50,000, 100,000 retail investor? Probably not, honestly. And most of the time, the relationship is close enough that you really know the background. It's really where it's a friend of a friend kind of thing, or if you're doing a 506C offering and you caught the advertisement, but you don't otherwise know the operators. If you don't have that pre-existing substantive relationship, and I'm borrowing that terminology from the SEC in terms of 506B offerings, but the reason I say that is if you don't know them that well enough to meet that threshold, then I think it's worth exploring their background and ask these questions of the GPs and get answers that you're confident in. Otherwise, don't put your capital up. I mean, it's as simple as that. So yeah, Justin, I think doing background searches is great when you have a larger risk position, but you could do it really at any investment level.
Guys, I do have a speeding ticket on my background. When I was 19, I was flowing with traffic. I argued that in court. So It should have been expunged, but in case you look that up, 19 years old, have a speeding ticket still on there. One of our large equity partners did that very same thing. You know, they're writing, you know, $10 million checks. So they do background checks on all the sponsors at Elevate. And that was one of the things that popped up.
Well, we want our sponsors to be safe drivers too, okay? Because we need you to
That's
get to
right.
the asset, manage it, and get to the bank to make our deposits, please. So that's good to know, Brian.
Yeah, for sure. I think that's important. I did have another question that I thought of. What about like investors investing in funds versus syndications? Is there anything?
Yeah, you know, my experience has been, I mean, the structure is different, and maybe we do kind of a fund structure call, you know, at another time. But really, the hallmark is when you're investing in a fund, particularly if it's blind pool, you have even more reliance on the operator because you don't have that. You're not anchored to a physical asset yet, right? You're just saying, hey, I'm going to give my capital to this operator, and hopefully they find an asset that I would otherwise approve to invest in. But once you commit the capital, that's all you got. You know, you're at the mercy of what the operator, you know, their strategy and ability is. Versus a syndication where it's like, hey, we're going to go buy Centerton 376. We're going to go buy this piece of dirt. I can see it, feel it. I could walk the property if I wanted to. I could take a trip there if I wanted to. And here's how this specific property is cash flowing. So some big hallmarks there. But when, you know, you guys are trending more in the direction of being able to accomplish, you know, a successful fund just because of your abilities and you know, going full cycle on assets. But from an LP perspective, just be asking yourself whether you trust the board enough to pick anything for you, or if you really like having that asset specific opportunity, in which case, you know, stick with the syndication stuff, at least for now.
That's great.
One other quick question, Nick, this is something that seems fairly new, and want to discuss like really quick how this could affect LPs, whether it will or not, but just, you know, a new offering coming out, how it starts as a 506B as in boy, and then turns into a 506C. Does that make any difference to the actual limited partner, whether they're investing when it's an actual B as in boy and it turns into a C, or like, is there anything they should know about this structure?
You're muted still. You're still muted.
Oh, thanks, Brian. You were asking about the conversion of a 506B to a 506C offering.
Correct.
Yeah. So yeah, conventional wisdom. There was some comment out there with FINRA, or excuse me, the SEC, you know, regarding having sort of a ramp up period or a scale back period. The SEC actually was clear in a no action letter that as long as you comply specifically and perfectly with each of the exemptions, you can even run them concurrently. So you could convert one to another, which is easy going from a B to a C, because once you convert to the C, you just have to prove the accreditation status of all the subsequent investors. But you can actually run them concurrently. Now, obviously, the cost of that up front is going to be quite a bit larger, but there is an opportunity, you know, to get your 506Bs and pull them through that offering, and then a 506C, you know, to pull through that offering. The difficulty is, and the operators would just have to be aware, is where a sophisticated non-accredited investor would catch wind of the investment opportunity in the 506C advertisement, and then the operator bring them through the 506B. As long as you're staying away from that, there's really no real risk, you know, to that offering. So some creative things that we've done and we'll continue to do for our clients to make sure that they meet their capital needs. So whether it's converting or even doing a concurrent, we've got that solution for you at RF.
Awesome.
Yeah, it looks like we'll be doing that on one of our next offerings here coming up, is a 506B to C.
And it's not a huge undertaking for us, especially from the B to a C. I'm really just modifying the references to the SEC language in the safe harbor exemption, just to make sure that it's abundantly clear that this is for accredited investors only, and proof of accreditation is a condition to subscription.
We had a question come in. What's a huge red flag when reviewing an offering? You're muted again.
Yeah, I mean, again, just lack of operating history by the operators. I mean, is really the worth. Looking at acquisition fees, if it's way above market, 4 or 5% on a large deal, something like that. A variable rate loan with no rate cap intended. Um, the ability to dilute membership arbitrarily. Um, things like that. I mean, it's really more of a facts and circumstances across the offering, not any one thing. But the one thing that you want to steer clear of is an operator who's kind of in their first or second syndication, because it can be the blind leading the blind, and just because they joined a mastermind, this, that, and the third, doesn't mean that they have the experience to operate an asset. So just be wary. Just be wary of your operators.
It's good stuff.
And I'm running on low battery here. It's probably important to tell our audience that it's probably my fault. I didn't have this on the calendar, and I saw my Facebook tag and then totally remember committing to this. And so I'm actually sitting in the Little League parking lot for my kids' game here that we have at 6 o'clock. So I'm about to go be dad for a little bit and kind of coach from the sideline here some baseball this evening.
Yeah, well, we appreciate you coming on and speaking with us, and hopefully helping our limited partners, protect themselves. Like I mentioned in a post earlier this week, growth of capital is super important, but once you get to a certain net worth, preservation of capital is just as important. So I think that's key. I guess where can our hosts or our attendees find out? This is going to be this is live, but also we're going to send out the recordings to our list. Where can they find more out if they want to reach out to you with any questions? What's a good?
Well, let's definitely, yeah, absolutely. Let's definitely do a part 2 of this. I want to sit there with a nice press shirt on and deliver a presentation, and we can do some other subject matter, maybe talk contracts or some other things. But in the interim, until we get to part 2, you can find me on LinkedIn. I'm under Nicholas G. Moore. And my email is Nick, Nick, at rfllplaw.com. And you can shoot me an email, drop me a note. If you have any questions, if you want me to review offering documents, please don't hesitate to pass those along in email. I'd love to help you out. There are LPs that still send me documents to review, and it takes about an hour of my time to review those and discuss it with you, and I'd be happy to do that. So I appreciate Brian and Justin, you guys hosting me this afternoon, and again, apologies for not bringing my best face forward here for you guys, but it's been a great time.
Yeah, it was great, and I think we hit a lot of the major points without getting too into the weeds there. So yeah, definitely appreciate it again.
Absolutely. All right, guys. Well, take care. I'm gonna head out here, and hopefully we win tonight.
Yeah. Good luck.
All right. Thanks, guys. Take care. Take care, everybody.
All right. See you guys.